I was staring at my bookshelf the other day at this, like, pile of trading books I bought years ago. You know the ones, Japanese candlesticks, Elliott Wave Principle, all that stuff. And it just, it hit me. There's this universal belief when you start out that the secret is hidden in some kind of information.
Oh, absolutely. The hunt for the Holy Grail.
Yeah. It's like, if I can just find that one secret indicator or that one pattern no one else sees, I'm going to crack the code. I'm going to be the one who beats the market.
We see it in almost every high-performance field, but honestly, nowhere is it more obsessive than in Forex and day trading. Millions of people are just convinced that their failure is, a lack of technical knowledge.
Right. You think, oh, I just need to learn order flow better, or my RSI settings must be wrong. But today, we are diving into a source that kind of grabs you by the shoulders and says, stop looking at the chart. Look in the mirror.
That's a great way to put it. We're unpacking a pretty heavy-hitting guide today titled Mastering Market Discipline, Overcoming the Overtrading Trap. And frankly, it opens with a statistic that should probably be printed on the warning label of every trading app.
That's the 90% rule, isn't it?
Exactly. 90% of beginners fail. They blow up their accounts, usually within the first 90 days. But here's the kicker, and this is what the source really drills down on. It is almost never because their strategy was broken.
So, wait, that's wild. You're telling me that 90% of people aren't failing because they're bad at predicting which way the market's going to go?
No, they're failing because of a very specific behavioral villain. The source identifies it clearly. Overtrading.
Overtrading, it sounds so, I don't know, harmless, like overeating or something. Just a little too much of a good thing. But reading this, I realized we're not talking about enthusiasm here. We're talking about a complete psychological breakdown.
It is a breakdown, and the source frames this as a trap that's like biologically wired into us. So our mission for this deep dive is to unpack why doing less, literally sitting on your hands, is the only way to survive. And we're going to get into the brutal math of what happens when you ignore this, and I'll warn you, the math section later, it's sobering.
It's terrifying. I actually did the calculations myself while reading, and it made me sweat. But let's start with the mindset. The source highlights this specific beginner misconception. The worker's fallacy.
Right. The idea that if I trade more, I'll make money faster.
Which, I mean, to be fair, that's how the rest of the world works. If I'm a freelancer and I take on 5 projects instead of 2, I make more money. Why doesn't that apply to the URSD chart?
Because the market doesn't pay you for effort. It just doesn't care how hard you stare at the screen. It pays you for correct decisions and managing risk. The source explains that when you try to force that hard work logic onto a market of probabilities, you just end up forcing trades that have no real edge. You stop acting like a sniper and you start acting like a machine gunner.
Spray and pray.
Precisely. And this leads to impulsive choices. You're not analyzing anymore, you're just reacting. And the source breaks this down into 2 main psychological drivers. The first one is the one we all know, FOMO.
Fear of missing out. But the way the source describes it feels so visceral. It's not just, oh, I wish I bought that. It's like a physical reaction.
Well, think about it. You're watching a chart. Suddenly, a huge green candle just explodes through resistance. It's moving fast. Your brain, which is wired for scarcity, starts screaming, "The train is leaving, get on!"
And you just click buy without checking your stop, without checking the higher time frame, just pure panic buying.
And you're usually buying right at the top, right before the retracement. You're providing the liquidity for the pros to sell into.
Ouch. Okay, so that's the greed side. But the second driver in the text felt much darker. They call it revenge trading.
This is probably the single most destructive state a trader can be in.
It's the gambler's fallacy in action, isn't it?
It is. The source describes the cycle perfectly. You take a loss, maybe you even followed your rules, and the market just went against you. It happens. But instead of just accepting it as the cost of doing business, you take it personally. You feel like the market attacked you.
The market stole my money.
Exactly. And your ego demands you get it back right now. So what do? You don't wait for a clean setup. You just dive right back in, usually in the opposite direction. And this is the killer. You double your risk.
Okay, I need to make back that $50 I just lost, plus 50 in profit, so I've got to bet big.
And now you've completely shifted from a probability mindset to a gambling one. The source says once you enter revenge mode, your IQ basically drops. You're trading on pure adrenaline. You're blind.
And that leads to what the text calls spiraling losses. I think anyone who's tried trading has been there.
Ah.
You start the day down 2%. By lunchtime, you're down 10% because you kept trying to fix it.
And by dinner, the account is gone.
So let's talk about that blowing up part. Because the source doesn't just say don't lose money. It breaks down the mathematical reality of why this destroys accounts so fast. This is where we get into position sizing.
Yes, the math of destruction. I think this is the most critical part of our whole deep dive today. The source sets up the scenario with two traders to prove why risk percentage is everything.
Okay, lay it out for us.
So imagine two traders. Both start with a $1,000 account. Manageable. First, we have the overtrader. This is the guy driven by that get-rich-quick impulse. He's risking, let's say, 5% per trade.
Now, hang on. To a total novice, risking 5%, it doesn't sound that crazy. You're keeping 95% safe, right? Why is 5% considered so reckless?
Because of something called the law of drawdown. The source walks us through it. If this overtrader hits a losing streak, and let's be clear, every trader hits losing streaks. Let's say he loses 6 trades in a row.
Which can happen in a single morning if you're overtrading.
Oh, easily. If you lose 5% 6 times in a row, mathematically, you're down about 26 to 30% of your entire account. You've lost nearly a third of your money in a few hours.
And here's the part that always gets people. It's harder to climb back up than it was to fall down, right?
Much harder. It's the asymmetric leverage of loss. If you lose 30% of your account, you don't need a 30% gain to get back to zero. You need a 43% gain on your remaining capital, just to break even.
That is brutal. So you have to perform almost 50% better just to get back to where you started.
And that's at a 30% loss. If you continue and lose 50% of your account, which is incredibly fast at 5% risk, you now need 100% return. You have to double your money. Do you know how hard it is to double an account?
For a beginner who's already tilted and emotional, it's impossible.
Exactly. The math guarantees failure. Now, contrast this with the disciplined trader from the source. They follow the 1% rule. They never, ever risk more than 1% of their equity on a single idea.
So on that $1,000 account, if they're wrong, they lose $10.
$10. Now let's put them through that same meat grinder. 6 losses in a row. A terrible, horrible day.
Okay, so they're down $60?
Roughly, yeah. Their account is at $940.
It's barely scratched.
They are still in the game, and more importantly, their psychology is intact. Losing $60 doesn't trigger that panic response. They can still look at the chart objectively. The source makes the point that the 1% rule isn't just about preserving your capital, it's about preserving your sanity.
That keeps you out of the revenge zone.
Precisely. You can survive a string of 20 losses and still have 80% of your capital left. The overtrader is wiped out by lunch.
Okay, so we know the problem is our own brains, and the consequence is the math just eats us alive. But knowing isn't doing. The source then pivots to a really specific 5-step toolkit to actually stop overtrading. And I want to dig into these because they're not as simple as they sound.
Let's do it.
Okay, step 1, plan your trades. No plan, no trade. But what does a plan actually look like? Is it just, I think gold is going up?
No, and that's a crucial distinction. A plan, as the source defines it, is a complete set of conditions. Before you even think about clicking the button, you need 3 hard numbers. 1, your entry point. 2, your invalidation point, that's your stop loss. And 3, your take profit target.
So if you don't know where you're getting out before you even get in, you're not actually trading.
You're gambling. The source says that if you're deciding on your stop loss after you've clicked buy, you've already lost. The pressure of that open trade will make you completely irrational. You have to make those decisions when you're cold and objective.
Makes sense. Okay, step 2 is, I think, a bit controversial. Daily limits. The source suggests a hard cap, like max 3 trades per day.
I know a lot of traders push back on that one. They say, well, what if the market's going crazy? Why should I stop?
Right. If I'm a scalper on the 1-minute chart, 3 trades is just my first hour. Isn't that just leaving money on the table?
For a beginner, no. The source argues that beginners suffer from something called decision fatigue. Every time you make a decision about risk, you burn a little bit of mental energy. By trade number 10, you are physically incapable of making the same quality decision you made at trade number 1.
So the hard cap isn't about the market running out of chances. It's about you running out of brain power.
Exactly. It forces scarcity. If you know you only have 3 bullets for the whole day, are you going to waste one on a random shadow? No, you're going to wait for the absolute perfect, high probability setup. It forces quality over quantity.
I like that analogy. Okay, step 3 is the risk rule, which we covered, stick to 1%. But I want to clarify something. When we say risk 1%, we don't just mean use 1% of your margin, do we?
Great point. No, we mean you calculate your position size, your lot size. so that if your stop loss gets hit, the dollar amount you lose is exactly 1% of your total account balance. It requires math.
So if my stop is wide, my trade size has to be smaller. If my stop is tight, my trade size can be bigger. But the dollar risk is always the same.
Always the same. That is the mark of a professional.
Step 4. Journaling. The source calls this the homework. And I'll be honest, this is the part everyone skips. It's boring. Who wants to write about their losses?
The people who lose money skip it. The people who win obsess over it. But the source suggests moving beyond just, dear diary, I lost money today. It suggests tracking actual metrics.
Like what specifically?
Things like maximum adverse excursion, which is a fancy way of asking, how much did the trade go against me before it went in my favor?
Right.
Or tracking your emotional state. The source suggests writing down how you felt before you clicked the button. Were you bored, anxious, angry?
Oh, that's really interesting. So you could look back after a month and see a pattern like, hey, every single time I traded while I was anxious, I lost money.
Exactly. The journal turns your trading from a random mess into a data set. You can't improve what you don't measure. If you don't journal, you are just doomed to repeat the same mistakes over and over again.
And step 5 is the mindset shift. Patience and discipline. The sniper mindset.
This brings it all full circle, back to the idea of doing nothing. The source really emphasizes that the majority of a trader's job is just waiting. It's sitting on your hands. It's watching the market wiggle around and just saying, no, oh, no, not yet, no, until that one moment where your edge appears.
And ignoring all the market noise.
Right, all that random chop in between the big moves. The overtrader tries to catch every little wiggle. The professional knows that 80% of what the market does is just noise, and only 20% is a real tradable signal.
The source wraps this all up with a case study that I found really surprisingly dull. And I mean that as a compliment.
I think I know the one you mean. The narrator describes a perfect trade.
Yeah. I was expecting some like Wolf of Wall Street scene, screaming, throwing phones.
Yeah.
But the narrator just describes sitting there drinking cold coffee. He sees the setup, a break and retest of a key level. He calculates the 1% risk. He places the order.
And then?
He just waits. The order gets filled. He watches it. It goes into a little drawdown, then moves toward the target. It hits the take profit. He makes his 2%. And he feels nothing.
Zero emotion. That was the key phrase in the text.
Right. But why is that lack of emotion the goal? Shouldn't you be happy you made money?
Well, if you get happy when you win, you're going to be devastated when you lose. You're just strapping yourself into an emotional roller coaster. The source argues that professional trading should feel like bricklaying. You put a brick down, check if it's level, put the next brick down. It's mechanical. It should be boring.
If you want excitement, go to Vegas. If you want income, be bored.
That's the mantra. The excitement in trading usually comes from taking way too much risk. If your heart is pounding, your position size is too big, period.
So if we zoom out, this whole deep dive into the overtrading trap is really about self-mastery. We started this talking about charts, but we're ending up talking about character.
It's 100% about character. The market is just a giant mirror. It reflects your impatience, your greed, your need for constant action. You can't control the market. You can only control yourself.
Which leads me to this final thought I had. The source asks this really provocative question about where else we're overtrading in our lives. Because once you get this concept that doing more often leads to worse results, you start seeing it everywhere.
It's the law of diminishing returns, but applied to your behavior.
Exactly. Like, take modern dating, the whole swipe culture. Isn't that just overtrading? You're flipping through hundreds of profiles, looking for the perfect setup, never really committing to one because the next one might be better. It's pure FOMO.
That is a fascinating parallel. You're looking for high quantity instead of high quality. And just like in trading, you probably end up burnt out and emotionally exhausted.
Or look at the workplace. We have this culture of busyness. If you aren't answering emails at 10 p.m., you're not a hard worker. But are you actually being productive?
Yeah.
Or are you just churning?
You're overtrading your energy. You're taking a bunch of low probability trades, spending time on tasks that don't really move the needle instead of waiting for the high leverage work.
And just like with a trading account, if you burn up all your mental capital on the noise, the petty arguments, the doom scrolling, the busy work, you have nothing left when the big opportunity actually shows up.
It really is a universal principle, isn't it? Your resources are finite. Whether that resource is the dollars in your margin account or your time and attention, you have to protect your capital.
Protect your capital. I love that.
If you treated your time with the same risk management a pro trader treats their money, you'd probably stop doing 90% of the things you do every day.
That is a brutal truth to leave us on. So for everyone listening, whether you're looking at a USD chart or just as your chaotic calendar, stop spraying bullets. Wait to the shot.
Be the sniper, not the machine gunner.
Trade smart, stay consistent, and we'll see you on the next deep dive.
Take care, everyone.